The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Hello, everybody, and welcome back to another episode of Fix It Friday. Today, I want to talk about something that hopefully will interest every listener, whether you're just starting out as investors or whether you've been investing for a very long time, and whether you have tens of millions of dollars or hundreds of thousands of dollars. Should apply to everybody. And what I'm going to talk about is what I see as the two roads in wealth management. One road that actually drives success and one road that actually derails it. So let's take a look at that and get more deeply into it.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Something today that I'm going to talk about is something that hides in plain sight in the wealth management industry. And the more you understand it, the harder it becomes to ignore. Because when financial advice starts to feel commoditized or interchangeable, one with the other, meaning one firm's advice with the other, then it probably is. And that's not surprising because much of the industry is essentially producing the same movie. They're just doing it under different directors, different branding, different slide decks, different personalities talking about it and presenting it. But underneath it all, it's the same basic playbook. So today I want to walk you through the difference between that conventional wisdom approach, as I refer to it, and the behavioral investment and counseling approach that we use here at Fusion Family Wealth. Because while the starting point when it comes to planning often looks similar between what a behavioral investment counselor might say and a traditional conventional wisdom-based advisor might say, the outcomes can be and often are dramatically different. So let's start with an important point. Like most thoughtful advisors, we believe deeply in planning. Real wealth management should begin by helping clients to find their objectives. What do you want your money to do? Who's the money for? What's the money for? And when will the money be needed? Are the three questions I always ask at the beginning of every planning meeting. Is it for your life, for your family, legacy, for your future? And then once we get the answer to those questions, we build a blueprint, or what we call in the planning industry, a financial plan that's designed to maximize the probability of helping each investor achieve the goals that they articulate. And only after that process of defining objectives and building a plan do we select investments to fund the plan. That's what I would call good planning on anyone's part, a behavioral counselor or a traditional conventional-based advisor. And I want to be clear, we deeply believe in the planning process. So a carefully thought out, creative, customized plan should be the foundation of everything we do as advisors in our industry. The difference between Fusion and, in general, behavioral investment counselors and the conventional wisdom approach of the industry doesn't begin there. It begins with how the investments are chosen. So in other words, it doesn't begin with the planning process, the setting objectives and the building a plan to achieve them. It begins with the third step, which, by the way, most advisors and investors often think is the only step. What are the investments going to be? How'd you do for the last 5 years? All those things that really are irrelevant, because how someone did for their clients, meaning the investments they chose did for the last 5 years, is a very narrow question. But when a client asks that, they're asking a much broader question. They're saying to the advisor, based on your answer to my question about how your investments did for the last 5, how then will I expect to do for the next 5 or 10 if I hire you? And with one thing, the other has nothing to do. Past performance is never an indication of future performance at all. That may sound cliche, but it's true. There is no statistical evidence for the persistence of performance. And so it all begins the difference with how the investments, again, are chosen by the investment counselor, behavioral investment counselor, and by the traditionalist. and what those investments are actually designed to protect against. Because the behavioral investment counselor designs their investment portfolios to protect against something vastly different than what the industry conventional wisdom advisory protocol designs their portfolios to protect against. So let's dig a little more deeply into that. So the conventional wisdom path describes most firms will ultimately move into a very familiar investment approach. It usually sounds something like this. We can forecast the economy consistently. We can predict which sectors in the marketplace will outperform others and underperform others, and when. We can identify consistently who the best managers of stock portfolios are going to be prospectively, and we can consistently give you a timing advantage, letting you know when, based on all of our forecasts, to get in and out of the markets and in and out of different sectors. In other words, what I call timing, selection, and prediction. And those ideas could sound intelligent. They sound proactive. They sound like value. But they're built on things that cannot be done with any level of consistency over time. And even beyond that, most firms use the same optimization models, Monte Carlo planning simulations, and other planning tools. They're all built around one very common and very dangerous assumption. And that assumption is that risk is defined as volatility. That if your portfolio moves around less, somehow you're safer from an investment standpoint. And from that assumption flows the conventional portfolio design. More bonds, particularly as we get older, less fluctuation, more smoothness, more comfort. But here's the disconnect. From a conventional standpoint, investments are often chosen to protect against short-term, temporary fluctuations in the number of dollars showing up on our portfolio statements each month. And that can feel safer. But feeling safe and being safe are not at all the same thing. And this is the point in the conversation where the paths really diverge. And as Robert Frost wrote, two roads diverged in a wood, and I took the one less traveled by, and that has made all the difference. That's exactly how I think about wealth management. There are two roads. One's built around minimizing temporary discomfort, and the other is built around maximizing the probability of long-term success. And the difference between those two roads is not academic. Over time, it becomes the difference between success and failure. Behavioral investment counselors think about risk very differently because strategies designed to protect against temporary fluctuations often lead to something far more dangerous: the permanent disappearance of the value of each dollar, or another way to say it is the permanent erosion of the purchasing power of our money. The irony is that over time, this typical conventional industry approach often produces the very outcome it's meant to prevent: unnecessary destruction of wealth. Wealth is defined by purchasing power. Let me say as clearly as possible, volatility is temporary. Inflation is permanent. That's the real risk. And there's a deeper misunderstanding underneath all of this. Most people think of money as dollars: $100 bill, $1 million, a portfolio statement with a certain number on it. But in my view, that's not really money. That's currency. It's a peerless medium of exchange. I know if I give you X amount of these dollars, I can buy that car. And that's all it is. Our culture, though, treats these currency units like they're a store of value somehow. They aren't. The only rational definition of money is purchasing power. In other words, what can those dollars actually buy? Because if I take $1 million and preserve it perfectly in bonds or even under a mattress for 30 years, at long-term inflation, it might take close to $3 million to buy what that $1 million bought at the beginning of the 30-year period. That is not preservation. That's the slow, irreversible, permanent loss of value. And yet, that's often what gets labeled as conservative. And that's the irony. What's commonly presented as safety, in reality, perpetuates the greatest risk of all. So my mentor, as I've said other times on my podcasts and my newsletters, is a gentleman named Nick Murray. He describes this in a way that really seems to resonate. He says there are two kinds of money. There's wealth, whose natural function is to grow, particularly relative to inflation. And then there is money that runs out. And he points out that while most conventional practitioners think of themselves as wealth managers, they are in effect managing the second kind. They are money that runs out managers. That's why at Fusion, we try to simplify portfolio decisions into two categories: essentials and refinements. The essentials are what actually drive long-term outcomes: having more stocks than bonds, being an owner versus a lender, much more in the portfolio, and making sure you have enough sevens versus threes, meaning roughly 7% returns from stocks after inflation versus 3% returns from bonds after inflation. That difference matters enormously over multi-decade retirements and certainly over multi-generational plans. Most investors don't need just a little more return. They need a lot more sevens than threes if they're going to reach their most cherished financial goal. Then there are the refinements: a little more or less small cap, a little more or less international exposure, 25% versus, say, 35%, or 20% versus 30%. Those refinements can matter, but they are not what long-term success pivots on. Too often, the industry builds entire value propositions around trying to get the refinements right, while misdefining the essentials, the big stock versus bond question. So now I want to share, because I don't want the audience to misinterpret my feeling in meaning that we don't think bonds fit anywhere. They do. In our view, they just don't fit for the reason the industry says they fit, which is to control volatility. We use bonds to control the timing of necessary withdrawals, particularly as our clients and investors get into retirement. And that's a very different purpose. Typically, for an investor in or near retirement, we might recommend allocating about 10 to 15% of a portfolio outside of equities, meaning to bonds or short-term cash equivalents, enough for about 2 to 3 years worth of spending into short-term bonds again or cash equivalents. And why do we do that? We do that so if the investor spending these in retirement happens to coincide with a bear market, which is defined as a 20% decline from a recent high. Now, mind you, the average bear market, that's a definitional bear market. The average bear market has been down 33%. So if we have these 2 to 3 years worth of spending dollars set aside outside of equities, then the client will not have to sell long-term stock investments while they are at depressed prices at the wrong time. That's the purpose to us of bonds. Timing, not of spending, not volatility control. The rest of the portfolio then can stay invested in assets designed to preserve and grow purchasing power over time, protecting our money against its biggest threat, not volatility, which, by the way, I don't think of as any threat, but against the permanent destruction of our wealth due to inflation that compounds relentlessly at about 3 to 4% annually over time. And that's very different from telling an investor to hold 30 or 40% in bonds, largely to reduce temporary fluctuations, because the extra allocation to bonds may certainly make their ride feel smoother, but it can quickly work against the very outcome the investor is trying to achieve. But once you understand that managing volatility doesn't protect what ultimately matters, and that timing and selection can't be executed consistently, the real question isn't whether that conventional approach is common, it's why it remains so widely accepted. That's the question worth asking, because when a process depends on prediction, selection, and optimization, it becomes commoditized. But when a process is built on clarity, discipline, and behavior, it becomes durable, scalable, and most importantly, valuable. So in the end, the two roads in wealth management don't just feel different, they lead to very different destinations. One road may leave an investor with a great deal of currency that has quietly lost all its value. The other is designed to preserve and grow the one thing that actually matters, purchasing power. And as Frost reminds us, the road you choose can make all the difference. In wealth management, that difference can ultimately become the difference between financial success and financial failure. So that's today's Fix It Friday, and appreciate you tuning in. Stay crazy wealthy, and you can catch us on our website, fusionfamilywealth.com, crazywealthypodcast.com, and all of your favorite podcast venues.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.